The Federal Reserve, also known as the Fed, is the central bank of the United States. It plays a crucial role in shaping the economic environment of the country by using monetary policy. Its main goal is to stabilize the economy by controlling inflation and promoting maximum employment. In other words, the Fed works to keep prices stable while ensuring that as many people as possible have jobs. To achieve these goals, the Fed adjusts the money supply and influences interest rates. Monetary policy framework. The Federal Reserve's monetary policy is a system of tools and strategies used to influence economic activity. The Fed primarily does this by targeting short-term interest rates, which directly impact overall financial conditions. By adjusting these rates, the Fed influences borrowing, spending, and investment decisions made by consumers, businesses, and banks, ultimately affecting the broader economy. One of the main objectives of the Fed's monetary policy is to achieve full employment, ensuring that nearly everyone who wants a job can find one. The other key goal is to maintain price stability, which means keeping inflation under control. Inflation occurs when the general level of prices rises over time, reducing the purchasing power of money. If inflation is too high, it can erode savings and raise the cost of living. On the other hand, deflation, when prices decline, can lead to reduced business profits, job losses, and economic stagnation. To strike a balance, the Fed aims to keep inflation at around 2% per year. It uses tools such as the federal funds rate, open market operations, and reserve requirements to regulate money supply and lending conditions. Lower interest rates encourage borrowing and spending, boosting economic growth, while higher rates help slow down inflation by reducing demand. By carefully adjusting monetary policy, the Federal Reserve works to support a stable economy, ensuring sustainable growth, employment opportunities, and controlled inflation. Its decisions impact everyday financial conditions, from mortgage rates to business investments, shaping the nation's economic health. Tools of monetary policy. To achieve its goals, the Federal Reserve employs several tools that help regulate economic conditions and manage the money supply in the financial system. One of the most crucial tools is open market operations, OMO, which involves the buying and selling of U.S. Treasury and federal agency securities. When the Fed buys these securities, it injects money into the economy, thereby increasing the money supply. Conversely, when it sells securities, it takes money out of circulation, reducing the supply. OMOs directly influence the reserve balances in the banking system, which in turn affects the availability of money for lending and borrowing. Another essential tool is the discount rate, which is the interest rate the Federal Reserve charges commercial banks when they borrow funds from its discount window. A lower discount rate makes borrowing cheaper for banks, encouraging them to lend more, thus increasing the money supply. On the other hand, a higher discount rate discourages borrowing, leading to less lending and a contraction in the money supply. The Fed also sets reserve requirements, which dictate the percentage of deposits that commercial banks must keep in reserve rather than lend out. Lowering the reserve requirement allows banks to lend more, stimulating economic activity while raising the requirement limits lending, which can slow down the economy. Lastly, the interest on reserve balances, IORB, is a tool the Fed uses to influence the amount of money in circulation. By paying interest on reserves held by banks at the Fed can encourage banks to either hold more or less money in reserve. This adjustment can influence the federal funds rate, which is the interest rate at which banks lend to one another overnight, further impacting the money supply and economic conditions. Recent developments in Federal Reserve policy. As of February 2025, the Federal Reserve has kept its key short-term interest rate in the range of 4.25% to 4.5%. This decision follows a series of rate cuts made in the months of September, November, and December 2024. Despite persistent inflation, with the Consumer Price Index (CPI) for January showing a 3% increase compared to the previous year, the Fed has opted to hold interest rates steady. This cautious stance is a reflection of the Fed's ongoing challenge of balancing the need to control inflation with the goal of supporting economic growth. The labor market plays a critical role in the Fed's decision-making process. Currently, the unemployment rate is at 4%, indicating a relatively strong job market. Additionally, wages are rising, which could add further pressure to inflation. While these are positive signs of economic strength, they also contribute to the complexity of the Fed's task in managing inflation. Rising wages may lead to increased consumer spending, which in turn could drive prices higher, making it more difficult to bring inflation back to the target level of 2%. Federal Reserve officials have acknowledged this delicate balance. Mary Daly, president of the San Francisco Federal Reserve Bank, has emphasized that the Fed must remain cautious until inflation shows more definitive signs of returning to the target of 2%. Similarly, Lori Logan, president of the Dallas Federal Reserve Bank, has pointed out the need to monitor economic data closely, including any shifts in fiscal policy and global factors. Logan stressed that even if inflation approaches the 2% target, the Fed must exercise caution. Inflation patterns at the start of the year have remained relatively high, making it essential for the Fed to be mindful of potential risks. The decision to hold rates steady highlights the complexity of the Federal Reserve's approach to monetary policy. Challenges. The Federal Reserve faces multiple challenges as it navigates a complex economic landscape. Inflation remains a key concern, with rising prices for goods and services putting pressure on consumers. At the same time, the job market remains strong, marked by low unemployment and rising wages, factors that can further fuel inflation. Beyond inflation and employment, the Fed must also consider broader economic influences, including fiscal policy changes. Recent tax cuts, deregulation efforts, and potential stimulus measures could create unforeseen economic shifts. The Fed's challenge is to balance these factors carefully to prevent economic instability. Another key issue is the Fed's average inflation targeting (AIT) strategy, introduced 5 years ago. This approach allows inflation to temporarily exceed the 2% target, as long as it averages close to that level over time. While this method provides flexibility, it has drawn criticism, particularly when inflation spikes. Despite post-pandemic volatility, the long-term inflation rate has remained near the Fed's goal. Chair Jerome Powell has indicated that the Fed will reassess its strategy in the near future, considering recent economic trends and remaining open to adjustments. As the Fed continues to manage inflation, employment, and fiscal policy shifts, its decisions will shape the economy's path forward. In conclusion, the Federal Reserve's role in the U.S. economy is central to maintaining stability and promoting growth. Through its monetary policy, the Fed works to control inflation and support maximum employment, which are vital for a healthy economy. By using tools like open market operations, the discount rate, reserve requirements, and interest on reserve balances, the Fed influences the financial system and helps guide the nation's economic direction. However, the Fed's job is not easy. The U.S. economy is constantly changing, and the Fed must remain flexible in its approach. It must carefully monitor inflation, employment, and other economic indicators, while also considering external factors such as fiscal policy changes and global events. As we move further into 2025, the Federal Reserve will continue to assess its policies and make adjustments as necessary to achieve its dual mandate of price stability and maximum employment. If you enjoyed this video, please subscribe to our channel. Your support is greatly appreciated. Thank you.